Not long ago, silver was trading in the low 30s and barely moving for months. Market experts labeled it a sleepy asset, just another dull hedge against rising prices that couldn't match the wild swings you'd see in tech equities or digital coins. Big money players paid it no mind, small-time traders wrote it off as capital going nowhere. Everyone agreed on one thing: silver had zero relevance for building modern investment portfolios. Now it's pushing into the 70s per ounce. In a very short time, the price moved like a market that just realized supply is tighter than anyone admitted. This goes way beyond your typical market swing. We're watching a structural fracture happen in real time. This marks the instant when a crucial industrial material shifts from plentiful to depleted, from manageable to wild, from steady to unpredictable. The consequences for American equity markets, especially the tech sector and manufacturing companies, are devastating beyond measure. But what separates this from every other commodity surge you've witnessed comes down to something critical. Speculation isn't driving this. Day traders aren't flooding into futures hoping to flip contracts for fast cash. Physics drives this. Geology drives this. The harsh truth that silver cannot be manufactured out of thin air drives this. Politicians cannot legislate it into warehouses. Social media posts won't materialize it in your storage facility. Once the global industrial machine recognizes that Earth's most conductive metal is running dry, no Federal Reserve action, no presidential decree, no congressional testimony can conjure more of it from nothing. Silver stands as the first asset in our modern age to slip completely beyond government reach while simultaneously proving essential to every major technological shift and energy transformation the planet is attempting right now. Solar technology requires it. Battery-powered cars need it. Next-generation wireless networks depend on it. Defense systems run on it. Hospital equipment uses it. Here's the kicker. Unlike petroleum, where drilling more wells is possible, or agriculture, where planting additional acres works, silver primarily emerges as a secondary product from other mining operations. You cannot just decide to extract more silver on demand. The Earth's structure won't allow it. Financial markets now face a situation without precedent. For the first time since oil shortages rocked the 70s, a tangible commodity beyond government control is positioned to obliterate the market values of the planet's biggest corporations, entities valued in the trillions built entire business frameworks. Assuming silver would perpetually cost $20 to $30 per ounce, manufacturing facilities, logistics, networks, production timelines, all constructed on that foundation just crumbled to dust. The adjustment ahead will redistribute wealth on a magnitude making the 2008 financial meltdown look like a modest pullback. Understanding why silver differs from every other asset category and why its price eruption threatens modern equity market architecture requires grasping silver's split personality. Silver functions simultaneously as industrial material and monetary metal. This double character generates a perfect catastrophe. No other asset can duplicate. From the industrial angle, silver conducts electricity better than any metal humanity knows. It outperforms copper in conductivity. It beats gold. No alternative material matches its performance. This makes replacement impossible in electronics, photovoltaic systems, battery-powered vehicles, and cutting-edge manufacturing. Constructing a solar panel demands silver paste to channel the electricity photovoltaic cells generate. No substitute delivers equivalent performance. Copper can work, but efficiency drops 15 to 20% in competitive solar markets. That efficiency loss means the difference between staying in business and going bankrupt. Battery-powered cars similarly consume roughly 25 to 50 grams per vehicle across electrical systems, battery oversight and charging infrastructure. As global production transitions from 90 million combustion engines yearly to a projected 70 million electric units by 2030, automotive sector demand alone jumps by 150 to 350 tons each year. That translates to 56 through 112 million ounces of fresh annual requirement that didn't exist 10 years back. Fifth-generation wireless infrastructure needs silver for circuit boards, antenna arrays, and radio frequency protection. Each 5G transmission tower consumes approximately 3 to 5 times more silver than previous generation towers, because higher frequencies demand superior conductivity. With millions of these towers under construction globally, another 50 to 80 million ounces of yearly demand materializes. Toss in medical devices, water treatment systems, exploiting silver's germ-killing characteristics, military hardware, including guided missiles and detection systems, plus conventional electronics. Total industrial consumption hits roughly 600 million ounces annually. This consumption isn't optional. This consumption is built into the structure. Corporations cannot simply choose to consume less without fundamentally redesigning products and accepting worse performance, but industrial applications represent only half the equation. Silver is also currency. Across 5 millennia, silver has served as money and value storage, unlike government-issued paper that prints infinitely. Silver is finite. Approximately 1.6 million tons of silver have been extracted throughout all human history. Worldwide yearly mining output sits at roughly 830 million ounces, about 26,000 tons. This output grows less than 2% yearly because silver primarily emerges as byproduct from copper, lead, and zinc extraction. Opening a dedicated silver mine makes no economic sense because silver concentrations in ore run too low. Most silver comes from ore being extracted for different metals. This creates a limitation absent from most commodities. When petroleum values climb, corporations drill additional wells and output increases within 12 to 18 months. When crop prices rise, farmers cultivate more land and production jumps the following season. But when silver values climb, production barely responds because mining decisions aren't driven by silver economics. Copper, lead, and zinc economics drive the mining. Silver just comes along as bonus material, so industrial consumption stands at 600 million ounces yearly. Investment purchases add roughly 200 million ounces annually from individuals buying coins and bars. Once that repricing starts, it accelerates because industrial consumers who previously purchased silver on just-in-time scheduling suddenly recognize they need reserves. This fear-driven purchasing creates a feedback cycle where climbing prices trigger more buying, which pushes prices higher, which triggers more panic purchasing. Now let me reveal the specific catalyst that transformed this slow-burning shortage into an acute emergency. Total mining output provides 830 million ounces. This leaves a gap of approximately 200 to 250 million ounces each year, requiring fulfillment from existing stockpiles, recycling operations, and government liquidations. Across the previous decade, this gap proved manageable because governments and major holders possessed reserves they could liquidate into markets. Those reserves are now exhausted. America's government sold its strategic silver stockpile decades back and maintains zero silver in storage. China has been accumulating instead of liquidating. Trading house inventories have dropped to multi-year bottoms. The cushion vanished. Once the cushion disappears, price becomes the sole mechanism balancing supply against demand. That's why the repricing has been so violent. Markets are repricing silver from abundant to scarce. In late 2025, China introduced new export licensing requirements for silver set to take effect in 2026. The announcement got buried in regulatory paperwork, and Western media largely missed it. The implications are massive. China functions as the planet's largest silver refiner, processing approximately 1/4 of global extracted supply and refining it into formats needed for industrial applications. Much of this refined material has historically flowed to America, Europe, and other manufacturing centers. Under the fresh licensing framework, businesses wanting to ship silver from China must satisfy strict requirements, including minimum yearly production capacity of 80 tons and registered capital of at least $30 million. These thresholds eliminate most small and medium exporters who've historically supplied Western markets. The intention is transparent. China wants to lock down silver supply for its own solar manufacturing, electric vehicle production, and electronics industries. China manufactures 60% of global solar panels, with aggressive renewable targets demanding hundreds of gigawatts of fresh solar capacity. China needs every ounce of refined silver it can secure. By choking exports, China guarantees domestic manufacturers get priority access while forcing Western competitors to scramble for increasingly limited supply. The impact on worldwide flows hits immediately. Beginning January 1st, approximately 150 to 200 million ounces of yearly refined silver that used to flow from China to the West simply stops. Western manufacturers who depended on Chinese refined silver now must source from South America, North America, or Europe, where refining capacity is constrained and already running near maximum. The supply shock strikes precisely when industrial consumption is accelerating because of the green energy shift. But China's export limitation represents only one component of the supply emergency. China tightens export flows just as industrial demand accelerates while mining can't respond fast enough. So price becomes the rationing tool. Once that flow tightens, everyone scrambles for the same limited metal at the same time. That's why silver ripped from the low 30s into the 70s in a short window. Markets are repricing from abundance to scarcity, and this repricing just started because the full impact hasn't struck industrial supply chains yet. Now let me demonstrate exactly how this supply shock cascades through American stock markets, because this is where genuine destruction happens. Climbing commodity input costs don't just damage profits, they obliterate valuations by shattering the growth assumptions justifying high price-to-earnings multiples. The cascade is simple. Higher silver prices raise input costs across tech, industrials, and renewables. When input costs rise faster than companies can reprice contracts, margins compress. When margins compress, growth assumptions break and the market stops paying premium multiples for future earnings. That's how a commodity shock turns into an index shock. Costs up, arrow, margins down, arrow, growth down, arrow, multiples down. Even without a recession valuation, math forces repricing. And if inflation prints stay hot because of commodity pressure rates stay higher for longer, which squeezes growth stocks even harder. Now here's the critical insight, connecting silver's price spike to the fundamental boundaries of government authority. Governments can control financial assets, they can control bond markets through central bank purchases, they can control currency values through interest rates and foreign exchange intervention. They can even influence stock prices indirectly through liquidity provision and regulatory changes. But governments cannot control physical commodities when geological constraints bind. Let me demonstrate why through historical examples this pattern has repeated throughout history. The second example is the Hunt brothers' silver corner in 1979–80, Nelson Bunker Hunt and William Herbert Hunt. Texas oil billionaires accumulated roughly 100 million ounces of physical silver between 73 and 80. They believed inflation would destroy the dollar and silver would be the refuge. They bought physical silver futures and financed purchases with loans collateralized by the silver itself. By 79, they controlled roughly 33% of the world's deliverable silver supply. Silver prices exploded from $6 per ounce in January 79 to $49.45 in January 80, an 825% increase in 12 months. The US government watched in horror. Inflation was already running at 13%. A commodity corner driving silver to 50 and potentially 100 would accelerate inflation expectations and destroy confidence in the dollar. The government needed to stop the Hunt brothers, but the government couldn't simply confiscate the silver. The Hunts were American citizens operating legally. The government couldn't force them to sell. What the government did was change the rules. On January 7, 1980, the COMEX exchange changed margin requirements for silver futures, increasing them from 10% to 100%. This meant traders could no longer leverage positions. You had to put up dollar-for-dollar collateral. This killed the speculative demand driving prices. Additionally, the Federal Reserve instructed banks to stop lending for commodity speculation. The Hunt brothers' strategy relied on borrowed money. When banks cut off credit, the Hunts couldn't meet margin calls. They were forced to liquidate. Silver crashed from 49 to 11 in 2 months. The Hunts lost billions and eventually declared bankruptcy. The government claimed victory. They stopped the corner. But notice what they had to do. They couldn't control the physical metal. They could only change the rules of the paper market to destroy the financial leverage that was amplifying the physical shortage. And this worked only because the Hunts were using leverage. If they'd owned 100 million ounces outright with no debt, the government would have been powerless. This brings us to today's situation. The current silver supply crisis differs from the Hunt brothers' corner in critical ways. First, the shortage is genuine, not artificial. In 80, plenty of silver was available. The Hunts created artificial scarcity through hoarding. Today, the shortage is structural. Annual consumption exceeds supply by 200 million ounces. China's export restrictions remove another 150 to 200 million ounces from Western markets. This is a genuine physical shortage. Second, the squeeze is distributed. It's not two brothers in Texas. It's industrial users, manufacturers, jewelry demand, and millions of buyers spread across the globe. Indian jewelry manufacturers, and millions of retail investors globally. The government cannot target a single entity. The government cannot change one rule to break the accumulation. This is a global diffuse shortage with no central point of failure. Third, industrial consumption is non-discretionary. In 80, silver was primarily used for photography and jewelry, both of which could be substituted or delayed. Today, silver is required for solar panels, 5G towers, and electric vehicles that are mandated by government policy. Governments are legally committed to renewable energy transitions requiring silver. They cannot simply decide to use less silver without abandoning their own climate commitments. This creates a paradox. Governments need silver to succeed at the energy transition. But governments cannot control silver supply because geology and Chinese export restrictions dictate supply. So governments are trapped. They need a commodity they cannot control to achieve goals they've legislated into law. The government is effectively powerless to control silver prices once physical shortage binds. This is the fundamental reality financial markets are now discovering. For decades, markets operated under the assumption that governments could manage any problem through monetary policy, fiscal stimulus, or regulatory intervention. The 2008 financial crisis seemed to confirm this. The Fed printed trillions, bought toxic assets, and prevented total collapse. The lesson learned was that governments have unlimited power to fix problems, but that power only works in the financial realm. The Fed can print dollars. The Fed cannot print silver. Congress can pass spending bills. Congress cannot legislate silver into existence. The President can issue executive orders. The President cannot executive order geology to produce more ore. Physical commodities represent the hard boundary where government power ends and natural law begins. And silver is the perfect test case because it's both essential to modern technology and constrained by geology. Markets are about to relearn the lessons supposedly learned in the 70s, when physical shortages hit, prices rise until demand is destroyed or new supply developed and governments can only watch. This is not financial advice. This is an analysis of why physical commodities represent the ultimate limit of government power and financial engineering. When geology and physics bind, money printing and regulation become irrelevant. Markets are relearning this lesson right now with silver. The cost of that education is being paid by shareholders of companies that built their empires on the assumption that commodities would always be abundant and cheap. That assumption is dead, and the adjustment process is going to be brutal for those on the wrong side of physical reality.